It's lovely to be here as spring starts, and thank you everyone for joining us today. We're here to say goodbye to the 24-25 tax year and hello and preparing for the 25-26 tax year, which will commence this weekend. Now, we're going to talk a bit about cost and compliance, and we know there's some of those additional items that are coming our way in 25-26. We've got some great speakers to help us delve into the detail here. Got Nicola Fraser from our Employer Services and Payroll team. Got Robin Bailey from our Global Mobility team. We've got Christian Fell, who's one of our resident experts in pay gap and consulting. We've got Nicola Bell, who's one of our specialists with HR services. And we've got Simon Sweeney to talk about financial outsourcing. So thank you everyone for joining us. My name is Ian Goodwin. I'm an employment tax partner at Forvis Mazars, and I help organisations with everything from cost reduction to reward strategy, all the way through to employment taxes compliance, be it IR35, national minimum wage, or expenses and benefits. So just a bit of housekeeping. We've got some question box. So if you want to put any questions in there, please feel free to use the Q&A, and we'll be time to ask questions at the end and get our speakers to talk those through. And this is being recorded, so it will be available to listen to afterwards should you wish to. And if there is a fire alarm, please do leave the room, as we will as well. We're not expecting any today, given we're all in different locations. So let's start off with my colleague Nicola. There's a couple of key dates that have come through, I think, for national minimum wage and national insurance. I think national minimum wage was yesterday, and national insurance changes will start to take place from this weekend. I wonder if you could add a little bit more flesh to the bone, Nicola, as to what's actually happening there.
Thanks, Ian. So, like you mentioned, the changes to both national minimum wage and national insurance, they're going to have a significant impact on employers. Firstly, we're going to discuss the changes and what impact these will have. And then we'll go through a couple of examples, comparing the costs from the 24-25 tax year to the upcoming 25-26 tax year. So firstly, national minimum wage. There's a notable jump in national minimum wage for the year ahead. Firstly, for national living wage, employees aged 21 and over will now receive £12.21 per hour, and that's a 6.7% increase. Then national minimum wage for 18 to 20-year-olds will increase to £10 per hour, and that's an increase of 16.3%. And then you've got your national minimum wage for your 16 and 17-year-olds, as well as apprentices, and that will rise to £7.55. That increase is 18%, and this is the highest increase to national minimum wage on record to date. So as part of the year-end process, we strongly recommend that employers review these rates and making sure that it's not just a once-a-year check, that this is continued through all payroll processes every time the payroll is run. And this will reduce the risk of further additional costs in the ways of non-compliant penalties that are associated with breach of national minimum wage. And then national insurance for employers, again, another significant movement, another large increase. So the threshold is moving from 9,100 per year down to 5,000 per year. And the increase of the rates will be from 13.8% to 15%. I'm just going to give a couple of examples of the figures and how that comes through. So based on a 40-hour week, a 21-year-old, their pay will jump a month to 2,116, and that's an addition of £133 a month for the employer. Then on top of that, you've got the additional NI cost, which comes in around £86 for that one employee. So over an annual basis, 21 and over on national minimum wage will cost the employer an additional £2,633. And then similarly, if we look at the 18 to 20 category, the monthly pay will increase by £242. But one thing we do have to note for under 21s, there is no employer NI liability. So the cost is just for the national minimum wage, and that is an annual increase of £2,912. And then similarly with your 16 and 17-year-old and apprentice, The increase is only for the national minimum wage because no employer NI is liable on those employees. And that's an annual increase of 2,391. Now, important thing to note is when I mention that the below 21s and the apprentices don't have an employer NI implication, that is only relevant if the employees are on the appropriate category in the payroll software. So for below 21s, that's the category M, and your apprentices under 25, that's category H. So making sure that your payroll records are accurate and reflect the position of the employee and their age will really have an impact on your calculations, and making sure you're not paying any unnecessary employer's national insurance. Now, to counteract these costs in the autumn budget, it was announced that there will be changes to the employment allowance. So this is an increase. So the employment allowance will rise from £5,000 annually to £10,500. And the rule preventing employers with NIC liabilities of over 100,000, that has been removed. Now, one thing to note on the employment allowance is if there is a group of companies, multiple entities, then this can only be claimed once across the group. So that's again something to be mindful of, that we're not incorrectly claiming this across multiple payrolls. And yeah, that's just a whistle-stop tour of those changes that are coming to the forefront in the next week or so.
That's great, Nicola. I think I was looking at this for a client the other day, and the one thing that jumped out to me was where you've got, say, a number of part-time employees, might be in the retail or hospitality, say on £10,000 a year. This national insurance change is going to increase the employer NIC cost by over 500%. It's massively significant. I mean, it's another £615 for each employee earning over 9,000, at least 9,100. So I think what you've laid out there is really important for employers to get to grips with. Some of the aspects that you might see, Nicola, and feel free to jump in here. I know from my perspective, it's helping people implement cost mitigation strategies, whether it be pension salary sacrifice, company car salary sacrifice, looking at how trunk arrangements could work, or car allowance NIC reclaim aspects to just save that national insurance. What discussions have you had with businesses to date related to those items? Have you had many?
Well, I know that clients are obviously looking to make those cost savings, and like you say, the implementation of salary sacrifice is something that is relatively a quick win for employers because it instantly reduces that cost. But one of the things that obviously I did mention was having employees on the wrong NI categories will just have such a significant impact, and those ongoing reviews and making sure that records are kept correctly will make such an impact on these businesses.
Definitely. No, definitely. And I suppose with the employment allowance as well, that's for all businesses now, other than a few exceptions. I think that might be related to the public sector and let's say colloquially one-man bands who may have been set up to get that. So it is available to all those other organisations. And like you say, you've just got to look at it from a group perspective.
Yeah, absolutely. That's the one thing you really need to be mindful of, looking at making sure you've not got it over multiple entities, because then you're just going to have a large liability at the end of the year when HMRC reconcile the account and realise actually this has been claimed more than once.
Agreed. And I think that's the same for the apprenticeship levy allowance as well. So you really need to look at your group claims there. So you should only be claiming one per group for both the employment allowance and the apprenticeship levy allowance. I know from a piece of work I've done for a client recently that we have had to do a disclosure to HMRC where I think they claim they had about 55 connected companies, and it's really important to look at that. So we had a quite a significant reclaim to pay back to HMRC on the basis that they'd been overclaimed for previous years. So it's a really good thing to highlight. So thank you very much for that, Nicola. I'm going to move from UK to more global issues, really, with my colleague Robin, who's going to talk us through what's going on from a global mobility perspective. Now, Robin, what are the key dates that we should be looking at initially from an immigration perspective?
Thanks for that, Ian. I think the first key date to look at is the 9th of April 2025. So why is this a key date? Well, the Home Office have announced that from that date, there are going to be some significant increases to UK visa and sponsorship fees for employers who recruit employees from overseas. So if we contextualize this, if we have employers, if you recruit large numbers of employees from overseas, and you typically will sponsor those individuals to obtain visas and work permits for them, these increases, these are going to be as high as up to £286 per application. Now, this could make hiring non-UK nationals considerably more expensive for employers.
That's great, Robin. And what should employers be really looking out for here?
Really, I think some common sense action is required here. What we would recommend that employers do is you identify any upcoming visa applications that you've got in situ, and ideally, where possible, submit those applications before the 9th of April deadline to beat those increases in fees. The other things that you should be doing as an employer, you should be looking to factor these increases into your global mobility budget, because things are going to get more expensive. And also, you've got to think about, is this the best route? Should we hire this person from overseas, or should we look at the local market in the UK instead? And if we think about this as well, let's just put this into practice from what we're seeing. Often what you'll see is an employer in their policy, they'll support both the individual, the spouse, and the dependents of that individual. So if we look at that £286 cost times 4 people, say family of 4, that becomes very expensive. And we add that to what a lot of employers do when they recruit overseas individuals. They'll pay for their relocation costs, tax support. That becomes a very expensive hire.
That's great, Robin. I know from looking at it from an employment taxes perspective, I've seen some companies paying the health surcharge as well for their employees, and they've not realised that that creates a benefit in kind like some of these immigration charges do. So it's important to look at it from that side of the fence as well as from the payment of the actual visa costs as well. So it's just something I'd provide a little bit of guidance on there to think about whether some of the visa and support you're providing from an immigration perspective could create benefits in kind, and take some advice there. So thank you for talking through the immigration aspects, Robin. Looking at it more from a tax mobility perspective, what areas here should we be focused on? What other dates should people be really concerned about?
So whenever I speak to my clients, Ian, that hosts employees from overseas, usually the first touchstone that we talk about are short-term business visitors from an internationalization perspective. What do I mean by that? I'm talking about where you have an employer who hosts non-resident employees from overseas. Typically, it's the case where they're in a corporate group and you have an employee that's employed by a non-UK company within that group. Say they'll come for a project or for training or as part of an international role. Now, when you have those employees coming into the UK, you can exempt their earnings at a PAYE level from UK PAYE payroll taxes if the UK company hosting those non-resident employees has something in place called an Appendix 4 short-term business visitor agreement. Okay. Now, if we look at for the tax year that's about to end now of 24-25, that agreement has to be in place with HMRC by the 5th of April. If that's not in place, then theoretically, the UK employer hosting that non-resident employee needs to apply PAYE to that short-term business visitors earnings. That's even the case if they're not paid by that UK employer, okay? And there's also an important point to make if we go to dates. Once you've obtained that agreement from HMRC, which is effectively a tax waiver to say we apply a double taxation agreement to exempt that individual's earnings at a PAYE level, by the 31st of May following the tax year, the employer needs to disclose details of the days that individual has spent in the UK, and where they spend significant amounts of time in the UK, over 150 days off the top of my head, they also have to provide further details to HMRC.
There's quite a bit to potentially do for some organisations that have people travelling into the UK then to make sure that they're not creating potential tax liabilities in the UK and have thought about that. I suppose there, Robin, is that the case for employees and directors, or is there anything different for non-resident directors here that we need to think about?
That's a really good point, Ian. What I often find when I speak to some clients who are new to mobility, there's some misunderstanding. So you may recall that I mentioned about the Appendix 4 agreement mimicking a double taxation agreement. Well, that has something called an employment income article that you can get an exemption if the business traveller spends less than 183 days in the UK and some other conditions are met. Well, for non-resident directors, the treatment is different because they're not employees. They're not covered often by the employment income article. That means often they can't be, in most cases, included in the Appendix 4 short-term business visitor agreement. What does that mean in plain English? Their earnings that are deemed to be attributable to their board's duties, where they come and attend as a statutory director, in theory, those earnings are subject to UK tax in full, unless you can obtain a direction by the 5th of April from HMRC to only apply UK payroll taxes to the portion of their earnings that are deemed to relate to their UK days. So running out of time, a little bit like the Appendix 4 agreement, if you want to get one of those directions in place for the 24-25 tax year.
Okay. And you talked about tax. Does that include Social Security?
Good point, Ian. So Social Security is different. Where you have people that come from overseas, from countries that the UK has a Social Security agreement with, what we would recommend for those short-term business travellers, you obtain something called a certificate of coverage from their home country, which basically says you're exempt from NIC and you continue to pay into your home country social security system. Some common sense is needed here, though. I have some employers, Ian, that take the approach of if it's less than 30 days, I've seen them say, well, administratively, that's a lot of work to do for such low amounts of days. So it comes down to pragmatism, commerciality, and risk tolerance.
Great. No, that's great, Robin, and thank you for sharing those. I know one thing that was probably discussed a lot last year in 24-25 has been the acronym FIG, F-I-G. Some people might not have come across that, but could you just explain a little bit about it? Because it's really important, I think.
Yeah, I'll try and translate this step by step. I think the first one, FIG, what does it stand for? Well, it's the Foreign Income and Gains Regime. Who is it actually relevant to? So you need to think about this if you're an employer. If you're looking to hire employees from overseas, or you've hired these types of individuals in the last 3 tax years, also particularly relevant if you tax equalize those types of employees. What do I mean by tax equalize? You pay the taxes on their behalf and equalize them so they pay the same tax notionally as if they'd stayed in their home country. Okay, but let's get into the detail a little bit now, Ian. Okay, so what has actually going to happen from the 6th of April 2025? Well, we're going to see the concepts of domicile and the remittance basis of taxation for non-domiciled individuals. That's scrapped from the 5th of April. And from the 6th of April 25, that's replaced by what we call the foreign income and gains, or the FIG regime, as you mentioned previously. So under the FIG regime, when you have employees that move to the UK from overseas and they establish residence here in the UK, their liability to UK tax on their foreign income and gains is going to be determined by their residence status prior to their arrival in the UK, which is different to the old rules, which was based on domicile, which is a completely different concept. So we moved to a residence style of taxation for inbound expatriates that come to the UK. And it doesn't matter now whether they remit that money to the UK or not, which is good news for the UK economy, because now those expatriates can spend as much money as they want in the UK, in theory, without attracting a tax charge. They can bring all of their wages to the UK.
Okay. And does it apply any relief to their employment income, this then?
That's correct, Ian. So it applies to employment income as well, but there is a restriction to that. Okay.
Okay.
So unlike non-employment income. When we look at foreign source income, employment income, what we're talking about is the earnings that the employee receives that relates to their non-UK work days. So if we think with someone, let's say they have a global role and they come to the UK, they may say spend 80% of their time working in the UK. And let's say they're part of a multinational group that's headquartered in the US. Let's say they spend 20% of their time in the US. Well, that 20% is sourced overseas, and that potentially qualifies for something called overseas workday relief. Because if you qualify for FIG, you potentially qualify for OWR, but it is limited. And for very high earners, this limitation is important. It's limited to employment income to the lower of £300,000 and 30% of the employee's taxable earnings. And this is looked at on a year-by-year basis. And it can get very complicated because we also have to look at it on a cumulative basis. So if you get paid a bonus or shares after the tax year is ended, you've got to theoretically take that into account in the limitation. So as you can imagine, trying to track all of that is going to be very time consuming for employers and employees.
Thank you for sharing that, Robin. And do you think overall this is going to be, as well as bring compliance, is there any good news here for people to really focus on?
Yeah, I think there are lots of positive measures here. The scheme itself is a lot more straightforward than the old remittance basis and domicile regime, because under that regime, in order to get that relief that I just spoke about on employment income, you used to have to enter into some very complicated bank account planning. So you used to have to set up overseas bank accounts, especially only put employment income into that account. You could only remit to the UK what related to your UK days. And there were very strict rules, which meant that you could effectively taint the funds and create a remittance. That goes under the new regime. You can remit what you want. It doesn't impact your taxes at all. And really, I think this makes this a far more competitive regime. Under the old regime, you got that relief for employment income for 3 years. New regime, 4 years, and it doesn't matter what you remit. So some positive news there, I would say, for those types of employees that come from overseas and employers that are looking in the global war for talent to hire employees from overseas.
That's great, Robin. I can see there's been quite a few questions coming, which we'll probably come to at the end of the Q&A. So thank you for sharing those aspects of it. I think moving away from tax and mobility, the other area that came to light in 24-25 is going to go, things that are going live in 25-26 is HR aspects and also pay gap analysis. So I was going to turn my attention to Nicola Bell. Thank you for joining us, Nicola.
Thank you.
But to start with, what do we really need? What dates do we need to be aware of, and what has been announced that's going to be effective from the next tax year?
Yeah, thank you, Ian. So on the 6th of April 2025, the Neonatal Care Leave and Pay Act comes into force. So this is designed for parents who have a child who is in hospital receiving palliative or end-of-life care. It's an additional benefit for them to support them during this period.
Okay, and is anyone eligible for this?
People are eligible, yes. To be eligible, you have to have been employed for at least 26 continuous weeks with their employer at the end of the relevant week, and have normal weekly earnings of over an 8-week period ending with the end of the relevant week that are not less than the lower earnings for national insurance contribution purposes.
Is this, I suppose, building on sort of statutory maternity pay and paternity pay? Is it an extension of those type of regulations, this?
Yes, it is, and it does actually work in conjunction with those.
Okay.
So whilst you're on maternity or paternity leave, you can actually have an additional claim for the neonatal care leave and pay. It was designed to, when parents are obviously having a very stressful time as it is, to give them a little bit more of a buffer so that they could focus their energy on their child rather than worrying about, money and stuff like that.
Okay, and what should employers do? Because is obviously additional potential cost and compliance. So what should employers be thinking about now to get this embedded for 25, 26?
Well, employers need to highlight the Neonatal Care Act to their employees.
Okay,
And they also need to ensure that their employee handbooks have been updated to include a policy relating to Neonatal Care Leave and Pay Act 2023.
okay, so document it basically and
Pretty much, yeah.
communicate it is the key thing to do
Yep.
for the new tax year. Thank you for sharing that, because for me that's something that I think about when I look at salary sacrifice and how that interacts with statutory payments. So it's really important potentially for organisations to start thinking, do we need to update our FAQs and things like that to think how these interactions might
Yep.
work. I know the other kind of big announcements or big discussion points over the last year has been the Employment Rights Bill.
Yeah.
Is that 25, 26, or is that still in discussion at this moment? And what is it about?
It is still in discussion at this moment. They have announced that none of the changes that they're talking about will take place until 2026.
Right.
But however, throughout 2025, there are consultations and discussion groups taking place to discuss the various changes that they want to make, because some of them are quite radical, and they've really want to introduce quite a lot of change.
What are the radical ones, Nicola?
Well, they want to remove the 3 waiting days for SSP. So that means that if you are sick and receiving statutory sick pay, you would receive that from day 1 instead of having to wait until the 3rd day. But perhaps one of the most controversial ones is to give employees full rights from their first day of employment. So currently an employee has to be employed for 2 years before they can raise an unfair dismissal claim against their employer. But once this bill is introduced, they'll be able to do that from day 1. So that's quite a significant change to where we stand at the moment.
So quite a lot for organisations to think about, and
yeah,
I suppose they're going to have to think how the compliance is going to work here. Not, we focused on tax, but this is more from a HR and legal perspective, and build that into their systems and get their teams trained up. Is there any kind of, I suppose, advice you'd give on how best to stay abreast of all these news updates, given we're going to have quite a bit to look out for in 2025 by the sounds of it?
Well, we're obviously going to follow the consultations and discussions, and we will be releasing insights and engaging with clients throughout the year just to keep them updated, so we can ensure that they understand what it means for them and more importantly, how they can stay compliant.
That's fantastic. Well, thank you for sharing that information. I'm going to now move to my colleague Christian, who I mentioned at the start, helps organisations with pay gap and consulting. What immediate and historic deadlines, perhaps, Christian, do we see for the public and private sectors here from a pay gap perspective? Christian may be having problems joining by the looks of things. So I'm going to move from Christian to my colleague Simon, who's not going to talk about pay gaps. I'm not going to put that on you, Simon, so don't worry about that. But I am going to ask you about financial outsourcing and what you're seeing businesses doing, and whether there are any deadlines people need to watch out for, whether this is just a watching brief generally.
Perfect. Thanks, Ian. Definitely not going to talk about pay gaps. Not my bag. So I suppose what I'm seeing with a lot of businesses is they're actually taking a look at their finance function and seeing what value it's adding. There's so many businesses that are spending way too much on their finance team. And a large part of that's around just with manual processes and not actually moving things forward. Technology's moved so much in the last year, never been the last 3 to 5 years. There's a lot of people still doing the same thing they've done before, which is crazy, because there's a lot more automation in finance technology. I suppose what a lot of people come to us in the outsourcing space for is actually to team an outsourcing solution with that technology, so they get the best of both worlds. And I suppose the easiest way to dip into that is looking at the simpler parts that you could outsource. And I mean, running a finance team is really expensive. I completely get that. It's a big bugbear for a lot of people in senior positions, especially with a lot of the basic things that are getting done manually, like people still using paper invoices. It's crazy. And I think all the talk that Nicola spoke at the start about increasing costs and employers and it's just going to increase the cost of your finance team even further. And you really need to look at the value that the finance team's adding, particularly in the more manual roles, such as processing invoices and sales invoices and whatnot. Technology's taken a lot of that over. So I suppose the main thing you could look at is if you were to dip your toe in the water, the easier things you could automate or put technology in place of instead is looking at things like supplier processing, customer invoicing, making payments. There's technology in place now that whole world is much more automated than it was before. Without using the big scary word that is AI, that's taken away a lot of that role of people doing the more manual processes. And if you're not really looking at that, you really kind of should.
And have you been helping businesses bring those into play then, Simon? How have you been doing that?
All technology, good people, technology and process. If you think about what technology's moved, as I mentioned a second ago, it's all about efficiency. If you haven't really looked at your finance team, your finance fund, even your processes in the last 3 or 4 years, there's a really, really high likelihood there'll be room for improvement. AI, as I mentioned before, OCR, all this technology should be in your finance function. If it's not, you really need to assess why. And I appreciate the concept of outsourcing. It can be quite scary. Like you almost feel you're losing control, but you're not. You're actually gaining more control by having somebody sitting on the outside doing these things that might have been repetitive or subject to maybe risk of being kept internally. And the one thing I would say is that you don't have to just go and outsource your finance function to get us to look at how things could be done better. We can come in and do like a one-off exercise. Just review what your finance team are doing, what could be done better, what technology can be put in place. And just to give an example, we're looking at an organisation, working with them actually. They were in a real squeeze on the public sector, real top line squeeze, and they're trying to save efficiencies within their overheads. They had a really inefficient finance team that was costing over 300,000. By just putting the various measures in place and putting technology in place of people and really strong processes, we saved them up to 45%, I think it was. So hundreds of thousands of pounds can be saved by putting technology in place.
Wow.
And it's massive. And a lot of people focus with all these costs coming in, how do we raise prices? How do we get more revenue? How do we increase the margins? But actually looking at your overheads, how much are you spending on your internal team that could probably actually be saved? Is somewhere where a lot of people will come to us to look at.
And for that type of exercise, how long would that take people to look at for, Simon? Would it be a quick job, take a bit longer?
We've got an amazing advisory team who can come in and they've seen so many different finance functions to see what's amazing, to see what's poor, so they can very quickly identify quick wins and also longer term pieces. So for example, a quick win could be just automating your supplier ledger or your customer processing, whereas the bigger piece could be a total new ERP function or a new accounting environment. So there's easy wins and there's bigger picture ones, all which we can support on.
And from I suppose a business size perspective, does it matter if it's a large or small business?
Not at all. So if you look at outsourcing or even just reviewing your finance function, we work with all sorts of businesses, all sizes. We've supported a lot in the mid-market space, but we work with a lot of fast growth businesses in the pre-revenue stage who are going to go and grow really quickly, but they need that structure and accounting environment in place to support that growth. And then at the other end of the spectrum, we actually support large NASDAQ listed companies with our outsourced solution. So size doesn't matter. We've got a technology solution that will apply to right at the lower level of turnover, right up to the very big players. And I suppose the beauty of it is because we can play to all markets, it's flexible. When you outsource your finance function, you only pay for what you need. So for example, you might have a full-time management accountant in situ, and you really only need them like 8 or 9 days a month, but you're paying for them full-time. Whereas when you outsource, you're only paying for what you need. So that wastage of just having somebody employed full-time is removed. And again, that's another cost saving, which kind of leads to the point of why would you not outsource? And I suppose the last bit, just because the things I've spoke about are at fairly junior level, and looking at outsourcing the transactional side of things, one place you can save money is FDs are exceptionally expensive, but you don't tend to need them if you're a business maybe turning over between 5 and 20 million. You don't need them full time. And what you can also do by outsourcing is just paying for that FD support maybe a day or two a month. You might only need them for month-end board meetings, strategic goal setting, and you can just outsource that rather than paying a massive salary. Again, another cost saving you can make.
That's great, Simon. Thank you for sharing those, because I think it demonstrates there's options to potentially counter the national insurance and national minimum wage rises that lie beyond looking at payroll. But I think from a payroll perspective, I'm going to bring Nicola Fraser back in here. What would you say is a good step to take next, given these cost rises are on us?
Yes, so from a payroll perspective, it's always good to complete an audit of your payroll, of where your business could be wasting time, wasting money, reviewing key compliance areas. The last thing you want is an unexpected additional cost, a penalty, because something hasn't been compliant within the payroll. And then, has there been any under or overpayments? Is there continuous reruns of the payroll? And really delving deep into why these are happening. Maybe introducing additional measures that can prevent these going forward. So, for example, we work with clients where we go into their business and provide an audit service where we audit everything from maternity pay, their system processes, their policies, their procedures, and we can really find ways of identifying inefficiencies in their processes and building them a bespoke report of key takeaways and areas where really there could be improvements made, and we can help them make those improvements and steer them down a different path that effectively would cost less and save time and money.
So there could be some obviously leakages there from not reviewing your payroll. I think from my side, Nicola, what we tend to work together on is, and I've mentioned it before, is things like if you've not done pension salary sacrifice, look at it because it can save some national insurance straight away. Not all pension schemes qualify, but the majority of the private sector ones will. Public sector sometimes needs a little bit more look at and sometimes don't qualify, but I'd say that's a really big thing. What we've also seen in retail and hospitality to look at is trunk arrangements, that's your tips and gratuities. If they've got pay as you earn and national insurance on, you can set up an approved arrangement to save the national insurance. That's something I'm very much looking at the moment. And I mentioned earlier, another one was car allowances, and you'll see them going through payroll all the time, Nicola.
Yeah.
Car allowances to people and they're driving their own vehicle, but you're paying them at less than 45 pence per mile for their business journeys. You can reclaim national insurance between what you're paying them and the 45 pence a mile. And that's not just up to 10,000 miles, that's regardless, because national insurance doesn't go down to 25p after 10,000. You can go back 6 years and you can claim going forward. My tip there would be, if we get a claim in this week, and a protective claim might just be a letter, you could go back to 18-19 tax year. Otherwise, we'll be going back to 19-20. And obviously then we've got COVID period that hits there. I think that's some of the areas I'm seeing from, I suppose, last sort of things, Nicola, on payroll audits. What would you focus on? What would be the main areas you'd really think, let's look at this?
Yeah, so what we've seen is that over the last 7 years, payroll has grown in complexity, even further back than that when pension compliance was put in place for payroll. That's something that has to be monitored every single cycle, assessing the workforce compliance regarding letters to employees, and then making sure contributions are correct as well. And then you've got things like the NI table letters I've mentioned. Are those correct? That is a cost saving, and that was again introduced to payroll in the last few years. And then we did see, which we'd never seen before, mid-year national insurance changes. So these complexities are continuing to grow. If it's a growing business with over 250 employees, then you've still got the gender pay gap to consider. Again, another complexity, another layer being added onto the payroll. So as the complexities grow, that is where we are seeing clients come to us for the outsourcing support, because the training and the cost of that training associated to make sure internal teams are brought up to speed, that they understand the changes. Is the software that they're using still fit for purpose if it's an internal team, or is it just something that's been ongoing and always used? Is it still fit for purpose, or actually is a lot of manual items and calculations going on in the background prior to going on the payroll software? So there's all these different considerations. And that's like when we see these clients come to us, because we have a large team of experts, we take that burden away. They gather the data that they need to put on the payroll, but we take the compliance, we do the calculations, we ensure the HMRC is brought up to speed, and really take over the responsibility and the onus of that key part of their business, and give them that peace of mind.
That's great. And I think from the discussion we've had today, I think it's fair to say, what Robin talked about with short-term business visitors and non-resident directors, we're going to have to think about how UK payroll interacts there. So there's some controls to think about in that respect. What Nicola Bell's just talked about on neonatal, any statutory payments you need to be really carefully calculate and consider and make sure you've claimed things properly and you're paying them properly according to contracts and policies that you might have as well. So there's lots of things that end up with payroll, the goalkeepers of the company in that sense. So
ever since real-time information was introduced, we have found that payroll continues to expand and grow, and I don't see it changing anytime soon.
Yeah, agreed. And then you've got national minimum wage, which people will think, well, that's managed by payroll, but actually it's a massive iceberg. There's so much that payroll won't see that the business needs to look at operationally, whether it be people working extra few minutes here and there, safety checks, whether they've had to buy black trousers or buy equipment. They've been the common example in the past, how salary sacrifice might interact, what type of worker they are. I know myself and my colleague Jane Gilmore have been doing a massive exercise with some of your colleagues, Nicola, on that to make sure everyone is talking to each other at the client side there. So it's something really important to look at. I'd say from my perspective as well, we talked about payroll audit. One of the other things to look at is your benefits and expenses. Big dates for the 25-26 and 24-25 are you've got your 6th of July for your P11Ds. You've got your 6th of July for getting your pay-as-you-earn settlement agreement in place on an ongoing basis for the previous year and going forward. And that's going to be your staff entertaining, your gift vouchers, your staff gifts, non-qualifying relocation costs, which might come into some non-qualifying costs potentially when someone's relocating from abroad to the UK potentially as well. And then we've got ERS filing, so for share schemes, securities, that's your 6th of July as well. So there's all these other things to look out for that don't potentially fit on payroll, but will need to be thought about as well and brought into the situation alongside. We know HMRC are consulting on the mandating of payrolling benefits and moving away from P11Ds. We've still got a bit to go there, I think, Nicola. The revenue is still looking at it and there's still not clear because there's so much you need to think about. It's not just a place of clicking the button, is it?
No, definitely not. I think the plan is that will be in place for the following tax year. And that's something, again, businesses really to be mindful, be prepared, and that will be a huge impact on a lot of payrolls.
That's great. I think from my perspective, I think we may have lost Christian, unfortunately. He may have disappeared from us. So I think the good thing is we're probably going to end there, and I'm going to ask each of my colleagues for their key takeaways from today. As you're already on the screen, Nicola, I'm going to ask you first. If there's one thing you could give a bit of advice to someone who's been on this call, what would you say?
I think make sure you've got the measures in place to mitigate any unnecessary costs. Make sure your payroll is compliant for national minimum wage. Make sure your employees are in the right NI categories. Are you claiming the employment allowance if you're due to have it? Please make sure you are. And apprenticeship levy allowance, briefly touched on that, but make sure you're claiming these allowances and you're not having any unexpected costs. And if you do feel that some of the things we've mentioned today are going to have significant implications and you are thinking of outsourcing your payroll, then that's something that should be considered, because that is another way to implement a cost saving for your business.
That's fantastic. I'm going to turn to Simon, who I can next see on the screen. Simon, your tip from today?
I think tip from today is you can hear from everybody speaking that costs are rising, wage costs are going up, and the knee-jerk reaction is always to stick the prices up. Whereas if you actually look at your overheads, like what you're actually spending, what can technology replace, and rather than pass it on to your customer and maybe lose a competitive advantage, maybe just actually look at technology, what it can save. Yeah, that's my takeaway.
Fantastic. I'm going to come to Robin next.
I think understands the rules for reporting for your expatriates. We spoke about short-term business visitors, non-resident directors, foreign income and gains. Then identify the employees that are impacted by that, put in place a policy and process to manage that, and ensure that you're compliant. Make sure that you've got the necessarily Appendix 4 agreements that we spoke about, Section 690s for non-resident directors, make sure they're in place and tie them back to payroll. Then make sure that you report correctly via the payroll on a real-time basis.
And definitely not, last but not least, Nicola Bell.
Hi. No, what I would suggest is that you look at your handbooks and make sure that you have robust policies in there that are fit for purpose, because where the biggest issues arise is where there is ambiguity, and that's where the tension rises between the employee and the employer, which again is going to potentially cost money to resolve. So make sure your policies are correct, up to date and fit for purpose, and it could save you in the future.
Fantastic. I think my tip from today is to make sure that all these things are talking to each other, and look at where you can make cost savings. Like Simon says, it might not just be from the payroll. It could be through looking at how you can outsource things or implement technology better. I know from my perspective, we're seeing some clients starting to think, well, should we reduce people's hours? You know, how can we implement things like salary sacrifice? What about if we relocate people from one part of the country where perhaps there's a waiting to another part of the country where there's less of a waiting on salary? So there's lots of things to consider, but it's taking some, I suppose, short-term and longer-term steps there. Some might involve technology. Some might just be, we've not done things like pension salary sacrifice. Let's get that in to make some savings, because it's going to increase people's net pay and it's going to bring in some national insurance savings for us as well. So I think we've probably finished on the takeaways. I think the next piece for me is just questions from the floor, really. What have we had from the floor, and what can we answer and help people with? Now, one of the questions I've seen on here is around if your UK payroll has different pay-as-you-earn references, can you claim the employment allowance for each pay-as-you-earn reference, or is it just for one? I'm going to go to Nicola on that. I think she's already preempted. That's great.
Yeah.
What's your answer there, Nicola?
You can only claim it across one entity, and one of the things to make sure of as well, the 100k is across that was across all the groups. So just to be mindful that the rules apply for the group, not just a single entity within it.
So if they've got two pay-as-you-earn references for the same company, you've only got employment allowance, really, haven't you?
Employment allowance, yeah.
That's great. And I've seen there's another question that might be more for me, Nicola, but I'm guessing both of us could answer it, was around the charities being exempt from the new national insurance rates. House of Lords thought, yes, that's a great idea, but the government have said, no, you're going to be paying it. Whether there's some payback through the government, I don't know, but everyone's going to be subject to the 15%, aren't they?
Yeah. And then, yeah, they've not said they're going to change it at this time. One of the things I did mention earlier was that we have seen mid-year changes come in before, so we may see something come out mid-year, but at this time, everyone is under the same rules, unfortunately. So the 15%.
Wow. I've seen my colleague Christian appear. So Christian, I'm going to ask you. Apologies we couldn't speak to you before. Gender pay gap. What should we be looking at now? What date is important for public sector and private sector? Is it too late?
That's a good question, Ian. Well, for public sector, hopefully you've submitted your gender pay gap results to the government website, because the deadline was at the back end of March. But for those of you in the private sector, you've still got 48 hours to go. So the deadline for any organisation with over 250 employees is 4th of April. If you're not there just yet, don't fret too much. There is time, but it's a very limited amount of time. So my advice for those that haven't yet completed this calculation would be to very quickly schedule a meeting with your relevant HR, finance colleagues to pull this data together alongside payroll. As we say, the deadline is 4th of April, and that's to submit your calculations alongside narrative. And this is what we really see now much more in the market, is organisations looking to build on their results itself. So not just what is your gender pay gap, but what are you doing to improve it? And much more, we're seeing employees and stakeholders engage in this information. So a really important thing to bear in mind as you look to the initiatives that you're implementing over the coming 12 months.
And are we seeing, Christian, just to look at this, so gender pay gap is something that's required through regulation to report on for those that qualify.
Yeah.
Do we see other organisations, probably less than that threshold and those above it, look at both gender pay gap and looking at other pay gap analyses, be it regional or ethnicity, that type of thing?
Absolutely. And it's something that we're seeing as a growing trend as well, whether that's ethnicity reporting or equal pay reporting, down to more granular levels. Often we see in gender pay gap reporting, it's looked at from an enterprise level, but equally, there can be a lot of value in segmenting that data, looking at it between different offices, between different role types. So there's an awful lot of information and analysis that you can derive from the same data set to make you more informed as an organization. But the growing movement certainly is to build on gender pay gap reporting and to look at these other areas as well.
And you need to go beyond just submitting it to the government and that leaving it at just that. I'm assuming you can, for those that qualify, you should look at how you publish this to your staff and also your colleagues and the external market, because it could help with recruitment and retention, I'm assuming.
Yeah, absolutely. What we're certainly seeing is more and more employees engaging with this. Gender pay gap now is a commonly referred to phrase. Post the deadline, gender pay gap results will be discussed widely in publications and across the press. We'll certainly see it spread across LinkedIn. So employees are aware of the gender pay gap results of their own organisation, and therefore it's really important to get the comms right around it, and also to use it. Gender pay gap doesn't tell you the whole story, but it does tell you something, and it's important to put it into the appropriate context.
Agreed. I mean, when we work together, Christian, on this, sometimes like how salary sacrifice interacts with these can be quite important. You potentially got some stories you need to get out there from how you set your reward strategy up, and potentially how people have, in their pension pots and things. Some people might be paying into a pension, some people might not be. So I know we've seen it from that side. To think that's something we need to basically speak about more vocally.
Yeah, completely. And NMW as well being a prime example of something that we often see pulled out of the conversations we're having around gender pay.
Yeah, agreed. And that, I know one of the conversations I was having last week with a client was around the wage compression that NMW is bringing, given those wages are going up by the amounts that Nicola highlighted, 6%, 16%, that type of level. The organisation by as much, and then what other opportunities do you have to structure pay, or whether that's non-cash or cash? I know from my perspective, the conversations I've been having more recently is what non-cash benefits could you provide? Life assurance, medical, company cars, be they electric because of the benefit in kind rate. Looking at things a bit more broader than that, home working, mobile phones, potentially staff suggestion schemes that you could get £25 tax and NI free for qualifying encouragement awards. That's been something we've been talking about with clients recently. So there's lots out there, and all those things will interact with pay analysis, won't they, Christian?
Yeah, completely. I think there's a real value in, whilst you've got this data set together and you've got an annual regulatory demand to analyse it, to be bringing the right people into the room here to look at it from these different angles.
That's great. That's great. Thank you for sharing that, Christian. Really appreciate your views and thoughts there. Now, we've had one more question coming to the Q&A. Are publicly funded bodies like GP surgery still prevented from claiming the employer's allowance? They are, yes, is the answer there. So anything that's got public services related to it will not be able to claim the employment allowance in that respect. So there'll be no difference from that angle at all. Unfortunately, they're one of the restricted bodies with the colloquially termed one-man bands as well that we've seen there. So that is unfortunate in that respect. But this is that's the answer from that perspective. I think Robin, there was one more question I had related to global mobility before we close, and that was where we have a situation where individuals are coming into the UK. They are receiving potentially, say, 40 grand a year from their country. they're over here for a short period. If they have to pay tax in the UK, would they potentially get a personal allowance so it wouldn't be taxable?
Potentially, Ian, but it depends if they're a country that we grant a personal allowance to. Okay, so where would you get that? It would be if you're either a UK citizen, Irish citizen, an EU citizen, or finally, in certain double taxation agreements that we have between the UK and other countries, you're also granted a personal allowance. One final point on that, though, it can be difficult often to claim that personal allowance at a payroll level because the PAYE code, back to Nicola and her team in payroll, you have to have a payroll PAYE code that factors that personal allowance in.
Thank you for sharing that, and we've had some fabulous questions. If anyone's got any other questions they would like to share with us, please do send them through. Really enjoyed the session. Thank you, Robin. Thank you, Christian, Nicola and Simon, and I appreciate our team as well up behind the scenes helping us with this. The recording will be available. Happy New Tax Year to everyone. We will be sending that out following this call, but we will also be sending the employer's tax calendar to everyone over the coming days as well. So thank you for your time. Please get in touch, and once again, happy new tax year to everyone, and we'll see what happens from Sunday onwards. Thank you and have a good day. Bye.